Welcome back for the latest stock news updates. For more videos that keep you informed, press the like button and subscribe. With that being said, let's jump right into the video. Wall Street underwent a whirlwind of reactions as Federal Reserve Chair Jerome Powell delivered a speech at the annual Jackson Hole Economic Symposium in Wyoming. Powell's statements about the central bank's readiness to further increase interest rates left investors on edge, initially dragging down major market indices. However, as the market digested the nuances of his speech, a new interpretation emerged. Powell acknowledged that inflation had eased from its peak, yet he emphasized that prices still remained elevated, keeping the door open for the Fed to continue its tightening measures. This led to a spectrum of opinions among analysts, with some predicting a more aggressive stance on interest rate hikes, while others anticipated a more measured approach. This balanced reading of Powell's remarks reflected Wall Street's adeptness at dissecting complex messages, allowing investors to regain their footing and maintain a cautious optimism. Powell's comments mirrored his speech from the previous year when he signaled ongoing interest rate hikes. Since then, the Federal Reserve has executed a cumulative increase of 300 basis points, positioning the Fed funds rate at levels not seen since 2001. As Powell's comments reverberated through the bond market, the yield on the 2-year Treasury surged to 5.069%, indicating potential changes in borrowing costs and investment strategies. This dynamic landscape underscores Wall Street's ability to adapt to evolving economic conditions and central bank policies. Next, we have a company that made a surprising move that invigorated the IPO market. Instacart, the revolutionary delivery app, has filed for an initial public offering with the U.S. Securities and Exchange Commission. This announcement comes as Instacart seeks to disrupt a relatively dry spell for initial public offerings. Trading under the symbol CART on the Nasdaq, Instacart's IPO stands out for its unique approach. Unlike many gig economy companies that have gone public while still operating at a loss, Instacart is entering the public market as a profitable entity. This, coupled with the backing of industry giant Pepsico, has generated significant interest from investors. Instacart's IPO prospectus revealed impressive figures, including $716 million in sales for the most recent quarter and a net income of $114 million. The company's innovative partnership with over 1,400 retail banners has transformed the grocery shopping experience, offering online shopping, delivery, and pickup services across a vast network of more than 80,000 stores throughout North America. One of the most noteworthy aspects of Instacart's growth trajectory is its gross transaction volumes, which experienced a staggering compound annual growth rate of 80% from 2018 to 2022. This substantial growth far surpassed the 50% growth in the overall online grocery market and the meager 1% growth in the offline grocery sector during the same period. With lead book running managers Goldman Sachs and JP Morgan at the helm, Instacart's IPO presents a fresh perspective on the evolving IPO landscape. You should also know that the pharmacy chain named Rite Aid is making headlines with its strategic preparations for a Chapter 11 bankruptcy filing, signaling a significant step to address its financial challenges. The company's confidential discussions with advisors indicate a proactive approach to navigate turbulent market conditions and legal pressures. With over 2,200 locations across the United States, Rite Aid is a prominent player in the pharmaceutical industry. However, the company has been grappling with a significant debt load and the fallout from legal battles. Rite Aid's decision to address its debts through bankruptcy demonstrates its commitment to charting a course toward financial stability. The move comes in the wake of a March intervention by the Justice Department, which alleged that Rite Aid knowingly filled unlawful prescriptions for controlled substances. This federal intervention followed a 2019 lawsuit filed by former Rite Aid employees. Amid these legal challenges and financial pressures, Rite Aid's proactive bankruptcy preparations reflect its determination to navigate these difficulties. Rite Aid's decision underscores the complexity of the current pharmaceutical landscape, where legal and financial issues intersect. As the company seeks a way forward, its bankruptcy proceedings will be closely monitored, and its actions will undoubtedly have implications for the broader healthcare and pharmaceutical sectors. Over in the entertainment industry, we saw a flurry of activity as AMC Entertainment, a major theater chain, navigated a complex stock conversion involving preferred equity units. This move, driven by a desire to regain pre-pandemic momentum, resulted in a noteworthy 8.4% decline in AMC's stock price as markets responded to the reconfigured share structure. The process involved a 1-for-10 reverse stock split, marking a significant step in AMC's strategy to convert APE units and initiate a new share offering for capital infusion. This intricate process was underscored by months of legal battles and regulatory considerations, reflecting the complexities of corporate maneuvers in a dynamic market environment. The stock conversion's complexity was further highlighted by the convergence of AMC's common stock and APE unit prices. A balancing act ensued as investors grappled with the dilution of their holdings and the impact on the overall value of the company. In addition to the stock conversion, AMC is set to make a litigation settlement payment. This payment, which translates to an additional share for every 7.5 owned as of a specific date, underscores the company's commitment to navigate a challenging landscape and revitalize its business. AMC's journey is a testament to the resilience and adaptability of businesses in the face of adversity. As the company seeks to reinvigorate its operations and reposition itself in a post-pandemic world, its actions will serve as a case study in corporate restructuring and strategic recovery. In finance news, we have Affirm Holdings, which is a prominent player in the buy now, pay later space, which is also known as the BNPL space. Affirm has experienced a remarkable 30% surge in its stock price, underscoring the growing momentum behind the buy now, pay later trend. The mid-afternoon rally reflected investor optimism fueled by Affirm's fiscal fourth-quarter results, which exceeded expectations. The rise of BNPL platforms has reshaped consumer spending behavior, offering an alternative to traditional credit options. Affirm's success in this space has garnered attention, with its year-to-date gains reaching an impressive 97.2%, despite a 42.5% decrease from the previous year's value. What makes Affirm's surge particularly noteworthy is its reaffirmation of guidance to achieve full-year adjusted operating profit by fiscal year 2024. CEO Max Levchin's commitment to profitability and disciplined performance showcased the company's strategic growth approach. However, the BNPL sector is not without challenges. Affirm's short interest, standing at 17.16%, points to varying perceptions among investors. As the BNPL landscape continues to evolve, Affirm's surge highlights the growing influence of alternative payment methods and the potential they hold for reshaping consumer finance. Affirm's journey exemplifies the intersection of technological innovation and consumer behavior shifts, making it a pivotal player in the ongoing transformation of the financial industry. Lastly, cloud software company Domo recently found itself in the midst of a storm as its stock price plummeted by nearly 40%. This sharp decline followed the company's revision of its fiscal 2024 guidance, highlighting the challenges it faces in an ever-evolving market landscape. Domo's journey through the financial markets has been marked by both successes and obstacles. The recent turbulence, triggered by the downward adjustment of its fiscal outlook, has drawn attention to the intricacies of operating in the competitive cloud software industry. An array of factors contributed to Domo's decision to revise its guidance downward. Tougher macroeconomic conditions played a role, impacting the conversion of its pipeline and adding uncertainty to its growth prospects. Additionally, intensified competition in the market has put pressure on Domo's renewal rates, with a handful of larger customers reportedly considering other options. One notable competitor on Domo's radar is Microsoft, a tech giant renowned for its comprehensive suite of products. The intensifying competition, particularly from multi-product rivals like Microsoft, has prompted a reevaluation of Domo's positioning in the market. Microsoft's ability to offer bundled solutions as part of broader enterprise-wide agreements presents a challenge for Domo, which primarily operates with seat-based pricing. In response to these challenges, Domo has taken measures to navigate the shifting landscape. The company is accelerating its transition to consumption-based pricing, a move aimed at addressing the competitive pressures and aligning with market demands. Simultaneously, Domo is focused on optimizing expenses and discretionary investments to ensure profitability and positive free cash flow. Despite the headwinds, Domo's guidance revision is viewed by some analysts as conservative, and its valuation is seen as undemanding, trading at approximately 1.5 times its projected 2024 sales. However, the journey ahead presents both opportunities and hurdles as Domo balances the need for profitability with the demands of an evolving market. That's all the stock news I have for today, so for more videos, remember to press the like button and subscribe. With that being said, I wish you happy investing.